So you're interested in buying a house and you're not sure which loan program is the right fit for you. Maybe you don't even know what different types of loan programs are out there. You're just in the starting phase. So I'm going to talk about the most popular loan programs in a little bit of detail. I'm not going to get super granular on it, in order to just provide enough information to get you moving in the right direction. Over time, I will add to this and maybe provides a little bit more documentation. But for now, we're going to talk about the most popular loans that are out there, and understand oftentimes your down payment, the type of property you're buying, whether you're buying it for a primary residence or a second home or investment, will dictate the type of loan that you can do. But we're going to talk about a couple of those things here right now. Now, if you're a buyer or a first-time home buyer, there is a loan that is often associated with first-time home buyers, but it's not really a first-time home buyer loan. Anybody can use this loan to purchase a home, and they can use it multiple times, and that is an FHA loan. An FHA loan is backed by the government. It allows you to purchase with 3.5% down. It can only be used on a primary residence, and you can purchase with as low as a 500 credit score. At a 500 credit score, though, you have to put 10% down. And anything under a 580, actually, so 579 credit score to a 500 credit score, you need at least 10% down. Anything above 580, you can get away with 3.5% down. Now, understand, a lot of times lenders have overlays on these programs. So while FHA allows lower down payments, or lower credit scores rather, these lenders might have an overlay on that program. So instead of allowing a 580, they may say you need at least a 640. So that's one of the frustrations out there with a lot of buyers, searching for loans, and saying, hey, look, I have a 580. FHA says I can do it, but I can't find a lender that can do it. That is a problem out there, and it may be one of the reasons that you have to shop around with multiple lenders in order to find someone that can do it. But that's one of the benefits of HOA. They allow lower credit scores, they allow lower down payments, and they also allow higher debt to income ratios. A lot of times FHA will allow you to qualify for more home because they allow you to have more debt, if you will, versus your income. They allow you to go up to a 57% debt to income ratio. But understand, with FHA loans, you do have mortgage insurance, MIP, not only that you have to pay up front when you purchase the home, but monthly. And it is on for the life of the loan. So as long as you have that loan and you put 3.5% down, you're going to have mortgage insurance on it. It's never going to drop off. But if you put 10% down, it will drop off after the 11th year. So that's some basics on FHA. Now let's take a minute and talk about VA loans. VA loans are loans for veterans, those that have served in the military, or spouses of those that have served in the military in some cases. Now there are certain qualifications you need in order to qualify for a VA loan. I'm not going to get into those right here, but VA allows you to purchase at 100% financing. So you can buy zero money down, no mortgage insurance. So there's no mortgage insurance like there is with FHA and or conventional. You can go down as low as a 580 credit score, but understand there's also overlays on that program with a lot of lenders. So some may not do that 580 credit score, and their debt to income ratio though is a little bit tighter. They only allow a 41 or so debt to income ratio on paper, but I have seen debt to income ratios over 60% in some cases get qualified. So they do allow higher debt to income ratios as well, even though their guidelines say they don't. Now, one thing about FHA and VA is that if you're buying a condo, it has to be an approved condo through FHA and VA. And there are lists out there where you can get those, but understand that's one of the downsides of using FHA and VA is that some of these condo complexes may not be FHA or VA approved, which means that you can't use that type of financing on that property. Now, there are ways around it, doing spot approvals. That's a whole different conversation, but that's one of the limitations in using FHA and VA. Conventional is typically associated with larger down payments in most cases, but they do allow financing as low as 3% down. A lot of times if you're putting 3 or 5% down on a conventional loan, FHA is actually going to be better as far as terms and lower monthly payment. But again, that's a conversation to have with your lender. Let them compare those for you and let you decide which option is best. Now, conventional loans can be used for primary residences, can be used for second homes, can be used for investment properties. Now, the down payments are going to change on the type of financing that you're doing. But for purposes of here, we're primarily talking about primary homes, buying, your first resident, your primary residence, if you will. Now, there are limitations on debt to income ratio. They're 43% or so on the debt to income ratio. They're a lot more strict than FHA and VA. So you're likely going to qualify for less home with a conventional loan versus that of FHA or VA. You are going to have mortgage insurance. Mortgage insurance is something that is required on conventional loans when putting less than 20% down. But understand, once you have 20% equity in that property, you can refinance and have that mortgage insurance removed. Or once you have 22% equity in that property because you've paid down the balance or that it's appreciated or what have you, you can ask for the PMI, the mortgage insurance, to be removed on that property and it goes away. Whereas on FHA, it would still be there. And conventional loans allow you to go down as low as a 620 credit score in many cases, but a lot of lenders, again, have overlays on that require higher credit scores. Now, understand, lower credit scores with conventional loan is going to mean a lot higher rate, whereas a lower credit score with an FHA loan doesn't necessarily change your rate too much. So there are definitely pros and cons to each program. Now, there are other loan programs like USDA loans, and USDA, I'll do a brief breakdown on that, allows you to purchase at 100% financing. There are income limits on that property. It has to be designated in a rural area as well. So there are certain things with USDA that are different from the others. And then you have loan programs like NACA that are supposedly allow you to purchase with zero money down. They don't monitor your credit scores, so on and so forth. But, if you have conversations or if you have questions about loans, talking to a mortgage professional can really guide you through that. This isn't a course on loans. It's, just giving you the basics so that when you have a conversation with a lender, you have an idea of what you're talking about and letting them guide you in the right direction. They're the professionals here. So, ask them the differences in the two, have them put one beside the other so that you can see it on paper which one is the best fit. But that should help in getting you started in the loan process and guiding you in the right direction.